Capital gains tax is one of the most overlooked drains on wealth in Canada. So whether you're selling a property or cashing out your investments or transitioning out of your business, it can quietly strip away a big chunk of your profits. For high net worth professionals or for business owners, the impact can be even bigger. So my name is Laurent Munier from Safe Pacific Financial, and in today's video, we're going to break down how the capital gains tax actually works in Canada, and more importantly, how to avoid unnecessary losses with the right strategic planning. What is the capital gains tax in Canada? So capital gains is a tax that you pay on the profit that you earn from selling a capital asset that has increased in value. So in Canada, this is a wide variety of assets that, many high-income professionals or investors or business owners would hold as part of their wealth building strategy. So really common things would be public investments like stocks, bonds, mutual funds, ETFs, or real estate. So not your primary residence, but cottages, vacation homes, rental properties. A business interest, so the shares in a private corporation, whether that's your business or somebody else's. Also collectibles and personal use property. So this would things like crypto, artwork, jewelry, cars. When you sell any of these for more than you paid, the difference is called a capital gain. So you pay tax on half of the gain. So 50% of the capital gain is taxable in Canada. So here's an easy, simple example. So you bought investment property for $500,000 and you sold it for $600,000. That's a $100,000 gain. Half of the $100,000 is $50,000. This is the amount that's taxable at your marginal tax rate, which for most of our clients is somewhere between 40 to 50%, depending on your income and depending on the province that you live in. So let's just say your marginal tax rate is 40% and you're paying tax on the 50. So you owe an additional $20,000 in taxes on that $100,000 capital gain that you made. So whenever you're investing in anything, really, you have to think about capital gains on the other end when you sell. So this is something that we do a lot actually for clients who have their value in their business or they have their value in their real estate or in a stock portfolio. We can work with them to protect their wealth from taxes and from market volatility. So we can help to design a custom financial structure to reduce or defer or eliminate capital gains tax in certain scenarios, all compliant, all within the CRA rules. So when do you pay capital gains if you're selling something in Canada? So the capital gain is triggered when it's called dispose of a capital asset that has increased in value. So that means when you sell something that went up. The most common way to trigger the capital gains, and this is what most people think about, there are other ways and there's other scenarios where you would have to realize it and pay a capital gain, even if you didn't sell the asset and even if you didn't receive any money. So here's some common situations to trigger capital gains in Canada. So number one, this is of course selling an asset. This is the most obvious case. If you sell real estate or you sell your stocks or you sell your business for more than whatever your adjusted cost base is, the profit is considered the capital gain and 50% of that is taxable. And this could be huge. Another way that you have to pay capital gains, and this is you're not receiving any money or even selling anything, you're gifting or you're transferring an asset. So even if you give away something to a family member, you might still be liable for capital gains. So the CRA would treat this gift as a deemed disposition, meaning that they consider it sold at fair market value. So if you gifted property or if you gifted investments and they've appreciated in value since you got them, you will still owe tax on that gain, even though no money is changing hands from you giving it to someone else. You definitely want to talk to your accountant and make sure that all of this is documented correctly if you're giving a large value gift. So this could be often in Canada, it's properties or down payments for properties or funding somebody to start a business, usually people's kids. Another way that you have a big capital gains bill without actually selling anything or even receiving any money, this is on death. This is on estate transfer. So this is usually people's biggest tax bill of all time is when they die, right? So here you go, death and taxes. This is the fun part. When you pass away, the CRA treats most of your assets as though you sold them right before dying. So this is known as a deemed disposition on death, and it can result in a huge capital gains tax bill for your estate. So if you're a high net worth Canadian and you've got shares in a holding company or you've got real estate portfolio or you've got a sizable investment account, this capital gain could be hundreds of thousands or millions of dollars? And do your beneficiaries, your kids, your wife, your husband, do they have the money to pay that tax? Or are they going to have to liquidate some of these assets in order to pay the CRA? Another way that you could have to pay capital gains without actually selling anything or receiving any money is if you convert your primary residence into a rental, or vice versa, if you convert a rental into a primary residence. So you're triggering a change in use. So the CRA considers this to be a disposition, so that capital gains tax may apply, probably is going to apply on any sort of accrued gain, unless you can file an election to defer the tax. Again, this is something that you talk to your accountant about. And so why does this even matter for business owners? So if you're an incorporated professional, say you are a doctor, you're a lawyer, you're an entrepreneur, an accountant, and you've got retained earnings inside your corporation, you're probably holding investments. You might have real estate inside this holding company. So without your proper planning, those corporate assets could trigger a major capital gains tax liability, especially if you exit or retire or pass away. So many Canadians are really shocked to discover that their estate could face hundreds of thousands of dollars in taxes from this deemed disposition. And if you don't have adequate cash flow or you don't have liquidity, your beneficiaries may be forced to sell assets to cover that tax bill, which is due immediately, and it could take years for them to pay this thing off. So at Safe Pacific, we specialize in creating proactive, tax-efficient wealth strategies, oftentimes actually using things like life insurance or an estate freeze or a holding company or a trust, so that you can protect more of your legacy and you can keep more of your wealth in your family. We obviously are going to work with your lawyer and with your accountant, or we could introduce you to the professionals in our network to get this type of stuff done, right? Like, we don't set up trusts, but we would tell you to go talk to your lawyer and get a trust set up. So when does the capital gains tax not apply? So what are some exemptions? What are some tax, shelters that you should know about? So good news, not every capital gain in Canada results in a tax bill. There's actually several powerful exemptions and different types of tax shelters available, especially if you're incorporated. So if you're a business owner, maybe you're a real estate investor, maybe you just have a high net worth. So understanding when capital gains doesn't apply is also important for your long-term financial planning and your long-term wealth preservation. So here's a couple of the big main scenarios where capital gains doesn't apply. So the biggest one in Canada is your primary residence exemption. So if you sell your primary residence, this is the home that you live in, the profit from that sale is 100% tax-free almost all the time. This is known as the primary residence exemption, and it's one of the most generous tax shelters that's available only to Canadian homeowners, because obviously you need to have the house in order to not pay tax on the house. So you can designate one property per family as your principal residence each year. So planning matters, especially if you own multiple homes or if you own cottages. So where are you living? Which one are you making most use of? Which one is going up in value versus not? So you want to plan out which one is going to be your primary residence if you want to take advantage of the primary residence exemption. Another big one is your TFSA. This is your tax-free savings account. So TFSAs are the best. Any capital gain that you earn inside a TFSA is completely tax-free. It's not tax-deferred, it's tax-free. So this means you can buy and sell stocks, ETFs, funds, other types of investments, REITs inside your TFSA, and any growth or any withdrawals, that's yours to keep, no tax. So this makes the TFSA one of the best tools for growing wealth efficiently in Canada. The only problem is that you're limited in how much money you can put into the TFSA. So generally, a good rule of thumb for financials is to just max out your TFSA as quickly as you can, and then also make the maximum contribution each year when the new contribution room is added in January. You definitely want to max your TFSA. Then there's not a lot of broad-based financial advice that works almost every single time, but maxing out your TFSA, if you're in Canada, you should definitely do that. Another tax advantaged account is your RRSP. This is your Registered Retirement Savings Plan. So when you invest inside your RRSP, any capital gains or interests or dividends are tax deferred until you withdraw the funds. So while it's growing, you're not paying tax on it. This allows those investments to grow without what we call tax drag. So this helps you to compound faster over time. And since you're probably going to withdraw from your RRSP in retirement, and your retirement income is probably going to be lower than it is when you're working, your effective tax rate at that time is assumed to be lower. So you're putting in money today, you actually get a tax deduction on whatever you put the money in. It can grow over time without paying taxes every year. And then when you take it out, the theory is that you're going to be in a lower tax bracket. So you're going to be able to take that money out for cheaper. Another big one is what's called your lifetime capital gains exemption. So if you own a business, this is a big one. The lifetime capital gains exemption allows you to claim up to $1.25 million today in 2025 in tax-free capital gains on the sale of a qualified small business corporation. So that's over $1 million in profit that you can have completely tax-free if your company meets the eligibility criteria. So, we work with incorporated professionals and entrepreneurs to structure their corporations to qualify for the lifetime capital gains exemption. So this involves proactive tax planning, asset purification is what it's called, and strategic shareholding, so that when the time comes to sell the business, you can walk away with the full lifetime capital gains exemption amount of the $1.25 million today. Now, why does this all matter? Why do these exemptions matter? So if you're not using these, you're probably leaving a lot of money on the table, or worse, you're paying unnecessary tax to the CRA. So proper planning can make that difference between losing 25 to 30% of your gains to tax, or keeping that money to reinvest or to retire or to pass on to your family, and you get to choose what to do with that money versus you send it to Ottawa and you let them choose what to do with that money. So we help high-income Canadians, we help business owners to set up these strategies around these tax-saving opportunities. So whether you're growing the wealth or you're exiting your business or you're planning retirement, so we help you keep more of what you worked so hard to earn. Now, how do you reduce or defer capital gains in Canada, right? So what are some smart strategies for professionals and business owners? So capital gains in Canada can eat away at your profit, right? But the right financial strategies in place, you can significantly reduce or defer how much you pay. So if you're an incorporated business owner, you're an investor, you're a high-income professional, this planning helps you keep more wealth in your pocket legally and efficiently. So here's some of the most effective CRA-compliant ways to manage your capital gains tax in Canada. Number one, you can use capital losses to offset capital gains. So say you sold an investment at a loss, like a stock or a real estate property. You can use that capital loss to offset capital gains in that year, or you can carry it forward indefinitely to future years. So this is called tax loss harvesting. It can significantly reduce your taxable income when you time it correctly. So for example, if you realized a $50,000 gain on one asset, but you also lost $30,000 on another asset, your net capital gain is $20,000. So that cuts your tax bill considerably. So some things you need to know. Definitely keep track of this stuff. So if you're buying or selling things that are going to generate capital gains or capital losses, have that documented, write it down. What day that happened, what were the numbers, how much did you buy it for, how much did you sell it for? Because you're going to need to give that to your accountant so that they can actually make sure that you're paying the right amount of tax and that you're not overpaying, and so that they can deduct the losses from the gains. So definitely keep good bookkeeping or good record keeping on this, and your accountant is the one that's going to be doing all of this. Another thing that you can do, you can time your asset sales around your income. So when are you selling things? Capital gains are taxed at your marginal tax rate, at the highest marginal tax rate. So the higher your income in a year, the more you're going to pay. So that's why you could defer selling assets until retirement or until a low income year. So if you're in a lower tax bracket this year or next year, then you could sell it when you're in the low tax bracket. This timing strategy helps you reduce the tax owed on the gain, and it helps you to keep more of the profit in your pocket versus sending more money to Ottawa. The third thing you could do, you could transfer assets to a corporation. And now here you need to be strategic, but for incorporated professionals, for business owners, transferring an appreciating asset, so like real estate or a stock portfolio, into a corporation can allow for long-term planning and potential tax deferral. So if you do this properly, so again, work with your lawyer, work with your accountant, work with your financial advisor, you can use this to move and you can use it to build wealth inside your corporation. So this gives you more control over how and when taxes are triggered. So obviously critical to work with the professional to ensure this is done correctly and that you're not triggering a deemed disposition unintentionally if you're trying to do this yourself. Another thing you can do, number 4, you can crystallize gains during low income years. So crystallizing capital gains means that you intentionally realize the capital gain now when your income is lower. And you can use this lower tax bracket efficiently. So this might make sense if you're, say, taking a sabbatical, or you're taking maternity leave or paternity leave, or you're having a gap year, right? So we have clients that have done this actually quite brilliantly. They had a bunch of money that they didn't want to touch, and then took a sabbatical, and went to Thailand and had a year of zero income. So they would be now for this year in the lowest tax bracket. And then you're like, okay, well, that's a good year to realize some capital gains. It's actually not a bad year as well to take out from your RRSP, because you're going to be in that low income tax bracket for the year that you're taking time off. So timing of when to sell or when to take the money out is also super important to know how much you're going to pay in tax and to try to reduce how much tax you're going to pay. And now, again, this timing is also a good strategy when you're planning income smoothing between working years and retirement. So it lets you manage your taxable income in a proactive way rather than letting the gains build and then you risk triggering a large tax bill all at once later on. Another thing you can do, number 5, is you can use certain types of life insurance, especially participating whole life insurance, and you can have it inside your company. So one of the most powerful and underutilized tools for reducing capital gains exposure, especially in the company, is participating whole life insurance. So we often help our incorporated clients to use this corporate surplus, they call it, or retained earnings, or just, profit that's sitting in your corporation to fund the life insurance policy. And then this is why it works so well. The cash value inside the policy grows tax deferred until you withdraw it. And then we show you how to never withdraw it, because you can then access that money tax efficiently through either policy loans or collateral loans. So you're either getting the money from the insurance company or from a bank. There's no capital gains tax on the growth inside the policy unless you take the money out. So again, when you're leveraging it from a bank, you're not taking the money out, so that tax never happens. And then on death, the death benefit is paid tax-free to, if it's in your company, it pays to corporation. Or if you're holding it personally, it'll pay to the beneficiaries that you have. And so that is a tax-free payout. And the life insurance payout bypasses probate and it bypasses the CRA involvement entirely. So this strategy creates a tax-exempt investment for your corporate money while also giving you liquidity and peace of mind. It's a really good way to take funds from the corporation without having to pay high personal income or have to pay capital gains tax. So this type of strategy is what we're really good at and what we're known for in the industry. So if it's something that you want to talk about, click the discovery call scheduling link that's either below the video or it's on our website at safepacific.com. There's a lot of buttons that'll take you straight there. If you don't want to book a meeting right away, you can also just send us a message and somebody will reply if you want to ask some questions. So why does capital gains tax matter so much for business owners or for a high-income Canadian? Now, capital gains isn't just something that affects stock traders or real estate investors. It's like a major financial consideration for business owners, for incorporated professionals, and if you're high income. If you're building wealth personally or through your corporation or your holding company, or you've got your non-registered investment account, chances are you are going to have a significant capital gains bill sometime in the future, unless you have a clear proactive plan in place. And this is especially relevant for these types of people. So a dentist or doctor with corporate investments or a professional corporation that's going to grow in value over time, those types of corporations can grow to a very big value. And that's going to be a huge capital gain on whoever, like if you're trying to pass that down to your kids or if you want to sell it. So having the right plan in place before you need it is how you want to get around that. Lawyers and accountants, again, when you're a partner at the company, you've got those shares or you've got a non-registered investment account that's growing. Maybe you're earning a ton of money and you're investing that money and you're generating yourself a huge capital gain in the future. Entrepreneurs and small business owners, if you're looking to sell your company. So this is a big one. And mistakes on selling your company can cost you hundreds of thousands or millions of dollars, right? So you want to work with somebody and make a plan before you need to. And then real estate investors, say you've got rental properties or vacation properties, right? Real estate is big and it's expensive. And when it goes up, that makes big capital gains. And if you want to keep these properties or you want to pass them down to your kids, somebody's going to have to pay this tax. So a good way to do that is with insurance. A good way to kind of mitigate the capital gains is to plan it out in advance, work with your accountant, work with your lawyer, work with your financial advisor. It doesn't have to be us. And if you're an incorporated professional, and you're just, you're saving in your non-registered account, you've got stocks, you've got ETFs or maybe mutual funds or something like that, and it's either personally or it's in your holding company, at some point in your financial journey, one of these things is going to trigger that capital gains tax. And here's another thing that's going to trigger that capital gains is when you sell your business, when you sell your company. When it's time to exit, so that's either a succession plan or you're selling or you're retiring, you're likely going to face capital gains on those shares or on those assets that you're selling. And without the right and careful structuring, this could be a 6 or 7 figure tax bill. And again, this is where we help business owners to plan for this years in advance. And you want to look into your lifetime capital gains exemption. Maybe you want to look into an estate freeze to be able to reduce or to eliminate that tax. Another big capital gains hit is when you sell or when you transfer real estate. So say you own some investment properties or vacation homes, or you've got rental real estate, you're subject to capital gains when you sell. Or if you transfer ownership to a family member or to trust, this applies whether the property is held personally or inside a corporation. So proper planning can help you to minimize that tax. And you want to structure your real estate holdings for long-term tax efficiency. So you want to do that upfront. Another thing that triggers your capital gains is just rebalancing your investment portfolio, which is something that you should do at least every year. If you've built a substantial non-registered portfolio, either personally or in your corporation, you're probably going to need to rebalance your holdings at some point. So you're going to have to sell some stuff and you're going to have to buy some stuff. So you're selling some stocks, some ETFs or mutual funds or whatever it is that's in there, private equity shares. These all trigger a taxable capital gain. So this will reduce your returns, right? And then you want to work with your financial planner or your investment advisor to ensure that the rebalancing is done in a tax smart way, especially if you're having a high income year, because the capital gains depends on your highest marginal tax rate. So if you're having a big year, you're going to be in the higher rates. So, and then you also trigger a capital gain, you're going to be paying more. So you want to time it, you want to plan it, and you want to work with people who are going to set this thing up in a way that you don't get hit with the max every time. And then this is probably the biggest one here is when you die. It's your death and your estate settlement. So many Canadians don't really realize this, that at the time of death, the government assumes that you sold all your assets at fair market value, right? We talked about this. It's a deemed disposition on death. This is probably going to be one of the largest capital gains tax events of your life. And it often blindsides the heirs. So with proactive estate planning, you can reduce or defer that tax burden and to protect your family's inheritance. So there's a bunch of different things you can do. And then also your family's going to need a way to pay that tax because you can reduce that capital gains, but you're probably not going to eliminate it down to zero. So using things like permanent life insurance, it can pay out on death in a tax-free way. And then your beneficiaries can use that money to pay the CRA. That's a lot. So let's build your capital gains strategy. This is what we do. We work with incorporated Canadians. We work with high net worth families. We work with business owners to build strategies that can reduce your taxes, grow your wealth, and then protect your legacy. We're very good at the large life insurance policies. And one of the biggest reasons that people buy these large insurance policies is to pay off the expected high capital gains tax on death. So you want to integrate your tax smart investment planning, your corporate structuring, your life insurance. You want to integrate your retirement and estate planning and make sure you have enough money to live. And then if you're sitting on unrealized gains or you're building your wealth and you want to protect more of it from taxes, there's ways to do that. So you want to set up a meeting with us or with your accountant. The easiest is with us through our website. It's at safepacific.com. This will book a time with one of our advisors and we can meet and see if we're a good fit to work with you. And if you're not ready to set up a time, that's fine. You just want to answer some questions. Go through the website, safepacific.com, and send us a message. Those will come to me. I'll make sure someone on the team gets back to you. And again, we operate on a philosophy of no pressure, no rush. So don't worry about somebody on our team calling you 100 times because you sent a message through our website. We're not going to do that. Ain't nobody got time for that, because yeah, I'm not going to do that. And then again, if this has helped to clarify anything about how does capital gain tax work in Canada and what can you do about it, do me a favor, please. If I helped you in this video, help me on YouTube. Like the video. Make sure you subscribe to the channel, which you probably should have already. Hit the notification bell, or if you've got any questions, leave a comment below. All of these things help the algorithm know that, hey, you see value in this, and to show you more of our videos and to show more of our videos to more people that are just like you. That's it for me today. I'll see you next time.